Hi, I'm Jack. Welcome to the Attract Capital webinar series. Today I'm here with Attract Capital CEO and founder David Barnett.
Hello everybody.
Today our webinar title is Different Types of Lenders Very Active in the Middle Market. So Dave, what does it mean to be a very active middle market lender?
Well, right now it means that you're doing deals, Jack, that you're going and you're blowing and that you're funding multiple deals on a monthly or on a quarterly basis. It means that you're in business, and it means that you're doing deals between 10 million and 200 million in deal size. It can be an asset-based or a cash flow-based loan, but you're aggressively putting out new funding. And a lot of these funds are actually what I would call recent vintage funds. They've recently been hatched. And a lot of it depends on, to gauge who's very active, it depends on their deal volume. So if they've done 2 deals in the last 12 months, they're not very active. If they've done 10 or 24 deals in the last 12 months, they're very active. So you really want to focus on those that are very active and those that have done a high volume of transactions.
And what makes these lenders different than mature lenders in the middle market?
They're pro-business and they're looking to get deals done, as opposed to having done a lot of deals and having a large portfolio to manage, where they've had some of those companies blow up in their portfolio. So they're not burdened with the mistakes of the bad portfolio. They're more aggressive and they're willing to stretch on a deal. And in another way of saying it would be, they see the glass as half full as opposed to half empty. And they're looking to put money out because a lot of them have been struggling to put it out over the past couple of years because of the situation we have with the pandemic.
Okay, and what are the different types of lenders currently very active?
So I'd say you have 4 or 5 of them. You have a multi-strategy asset managers who do private and public deals. You have recently raised funds. They can be business development corps, or they can be existing debt funds with existing managers, where they raised a 4th fund or a 5th fund. They could be crossover debt and equity funds. Usually they can invest in either public investments or private investments, similar to a hedge fund. They can be private debt funds, which are usually affiliated with large asset managers, or business development corps if they're public. And also family offices have gotten involved in the middle market because family offices see the yield, they see the stability of the underlying return, that the middle market has done well over the last 30 years through 5 or 6 different recessions, a couple of them great recessions. So people see the inherent attractiveness of the asset class.
And how would you assess the level of funding capacity in the market right now?
There's never been more money in the middle market between all these different platforms than there is right now. And one statistic that we saw earlier this year was that there was in excess of $1 trillion between all these different platforms looking to find a home. Now, not all of it will be in the middle market, but a large percentage of it will be in the middle market. These platforms are loaded with capital right now, and as much as interest rates are going up, and as much as the selectivity of the lenders is also going up because we're in a recession, we're heading into a recession, I think there's probably never been a better time, if you're an above average company, to bring in middle market financing than August 2022.
Well, there you have it. Thank you for tuning in, and we look forward to seeing you next time on the Attract Capital webinar series.
Thank you.